Nitin Rakesh joins in to talk about what lies ahead for the market. So, Nitin, morning. Thanks for joining in. What's your sense of how things have shaped up for the market so far? Just consolidating before making a bigger move for itself, or do you think that the rally is about done here?
Morning, guys. I think we are obviously working through a set of issues, both global and domestic, and I think till such time that we have a little more clarity on both, I think the markets will kind of continue to stay range bound, even though they're broken out from the lower end of the range between 47 and 52, and right now are above 52. So clearly, I think there is at least some cushion, some floor that's been set on the downside, but I think we need a little more clarity on a lot of macro issues before we can plan the next move up. And I think that at this point in time, it looks like the domestic issues are a little more a cause for concern for the market. And obviously, while the rest of the world tries to figure out problems in Europe, I think the domestic problems really are something that's weighing on our markets, and that's the reason why we are underperforming compared to our Asian peers over the last few days.
If there is some kind of resolution next week to issues in Italy and by extension to what happens with the Eurozone, Nitin, what potentially does it imply for our market? Because as you pointed out, we've been quite sedate in our gains.
Again, I think it looks like that at least there is some resolution coming into place in Europe, starting with Greece and then Italy. We obviously worked through issues in Portugal and Ireland before. Having said that, I think this might just be the beginning of the end of the troubles, but it's still going to be a long road ahead given the nature of politics and finances involving a large number of countries. So clearly, I think the ECB needs to decide whether it's going to print more notes or whether it's going to raise more money, and the source of capital for the rescue fund clearly is one issue. And if they decide to do print notes, then that will actually lead to some more problems for us, because that will stoke inflation worldwide again, given the fact that a lot of that liquidity will again be flooded in the markets. I think the issues are much more global, domestic in nature, that are causing a lot of concern, and that's why you saw a little more subdued trading over the last few days. And unless we see what the government trying to work those things out, especially the deficit issues. I mean, not only do we have a problem with fiscal deficit and current account deficit, I think even our trade deficit is actually very scary based on the numbers that came out yesterday. So I think we do need resolution to the domestic issues before the market will start to feel easier.
Nitin, hi, morning. Just as an extension of that question, do you think that the domestic issues, if they spiral out of control, could perhaps take our market below that bottom end of the range you were talking about, at about 4,700 or so?
It's very hard to say right now because these are developments that are still in motion. Obviously, a lot depends on how the policy and RBI response to some of these developments happens. Obviously, RBI is fairly cognizant of the fact that the yields have inched up even from over from where they were when the RBI policy came out a couple of weeks ago. So I think we need to wait and watch and see what the government action is. The December Parliament session will be very, very crucial, because it's the only one before the budget session now. So I think the markets will look towards Delhi and towards RBI to see what their stance is going to be, what their plan is going to be on controlling the deficit, whether they will step up the pace of disinvestment, whether they will open up the window for FIIs on debt, that they've been talking about, how they will fund the trade deficit, what will be the impact on rupee, whether RBI has a stance on that. So a lot of things depend on the response from the government, and if the markets don't find comfort and resolution, I think that will put pressure on the prices.
How have you reacted to this asset quality pressure that many PSU banks have faced of late, and what are you expecting to hear from SBI that has been a victim of slippages for a while now?
Again, I think that's another symptom of the high interest rate environment, and numbers from PSU banks have been fairly disappointing, at least in terms of their provisioning and their NPAs. Even if you look at Bank of India last night, or last evening, it was actually fairly a disastrous number in terms of the NPA levels. SBI will obviously be the most crucial number today. It will cap off the PSU results and also give a direction on what that segment will look forward to for the next 2 quarters. I think NIMs should be fairly stable, 3.5%, 3.6% is what the expectation is. But the bigger question really is what happens to their provisioning. They had a pretty big number last quarter. So expectation is not very high, even with the stock rally yesterday. But I think the issue really is whether we are out of the woods from a provisioning point of view, and the market is not really expecting a lot given what's going on in the rest of the PSU pack. Obviously the private banks have done much better on that front.
How's money tuned into this market in this risk-on, risk-off environment, Nitin? On the money parameter, do you sense more interest or as much apathy?
I think we saw some 3,000 crores of net flows in October. For the calendar year to date, we are barely $500 million net flows. So compare that to the 30-odd billion we got in calendar year 2010. So this is clearly a disastrous year from that point of view. If you look at fund flows globally, emerging markets got 3 billion flows last week. Doesn't look like we got a lot of that, given I think some of the issues that we are seeing on the domestic front. I think people have seen a lot more comfort from the macro situation in China, for example, and I've talked to some portfolio managers who manage global monies, where they've actually seen some pretty good trading opportunities coming out of the valuations in China. Chinese banks, given the cooling off of inflation, have given almost 50-60% returns from the bottom. So that's probably where things seem to have been a lot more in focus, at least on the EM front. But if the environment globally becomes more conducive to risk on, which with the resolution of the European crisis might be likely, then obviously emerging markets as a pack will definitely see flows coming out of the DM world, which for the year has been fairly muted so far. Whether we get some of those flows over the next 2 months, obviously looks like we will get a little more flow than we did in the last 6. But I think a lot of things are still dependent on how we react to our situation domestically.
So tactically, how are you playing this, Nitin? Does it seem more likely that any surprise rally from the market or any significant upside has gotten postponed into next year, or do you think that possibility is still open, so it's better to approach this market from the long side?
I think we are obviously, we run long money portfolio, so we are always long biased. And within that long bias, what we try to focus on is where can we find relative pockets of strength or a lot less capability for the prices to be damaged. So we've kind of stayed focused on pretty much the same themes. We've always been positive on things that are consumption focused, including automobiles, telecom. IT has obviously been a good place to be in given what's happened to the rupee. And with the current data coming out on the trade deficit, I think rupee will stay under pressure. So IT seems to be be a good place to be in because they have the tailwind of currency with them, even though the global environment is still really iffy and uncertain. We stayed away from high interest rate sensitives, even though we've had a scattering of banks that we focused on. But I think we stayed away from construction and real estate and infrastructure, and we still continue to look at them with a little more discomfort. I think the only interest rate sensitive that we'd like to play will be banking to some extent, given that at some point our interest rate cycle is going to taper off. But other than that, I think we've stayed focused on a lot more sectors that are a lot less dependent on interest rates, and at the same time are much more domestically focused from a consumption point of view.